Right, welcome guys. This is Price Action Principles Trading a Range, Module 4, Ranges, Liquidity and Targets. This is a monster of a module. It's 91 pages long, so we've got a fair bit to get involved in. So yeah, strap yourself in and let's kick off. Disclaimer. Now, you may have heard before, the missus watched my videos and she gave me a bit of a bollocking for doing the old Golden Globes Awards. If I was up on the stand, they would draw the curtain on me for talking about the disclaimer so much, but please, the gist of it is note that any trades that are shown in the following content are for educational purposes only, and any risk is borne by you, not me. So again, down the bottom, this content is strictly provided for educational and entertainment purposes. I've also made the mouse cursor bigger. There was someone that DM'd me on Twitter and said they struggled to see the cursor as I was whittling it around. So now I've made it bigger, and hopefully that can actually help a couple of people as well. Acknowledgement. So this was the other Golden Globes Award the missus bollocked me for, but I would just like to take a moment, and I can quickly run through these people, but look, they have all certainly had influence on me as a trader and educator, if you will. So the first one is the 2017-18 market. It absolutely whooped my ass, and I wouldn't be here without its unforgiveness, if you will. And yeah, the inspiration it gave me to want to succeed and have the hunger to learn. So next one is Crypto Cred. He is the legend amongst educators in the crypto space. His videos and educational content are what really set me off down the rabbit hole. So yeah, I cannot thank him enough for being such a handy fella in that respect and taking the time to make so many hours of videos, because I do truly understand what it's like now. Trader Main. So I did find his Discord, the PA Palace, and I observed through his public streams and charts that we did have a similar learning. So through ICT that he publicly will always acknowledge as well. And so yeah, I dusted off my 2017-18 trading wounds and got back in the saddle, and took a lot of inspiration from that. Next chap is RecProof. So he's the price action legend, smart money concepts guru, and he truly inspired me to take action through his public content. So no thanks are enough to him. Through what he shared, it kind of just unlocked that last little bit for me in terms of being able to share my own knowledge with everyone. So really, really thankful for that. Emperor BTC, and I cannot believe it, but there is a crappy spelling mistake there again. And look, no thanks are enough. He gave me a voice to share my passion. He helped me out in that respect. He did mentor me, and look, I can't thank him enough in that respect. So nothing I can do to share my gratitude even more. And then Inner Circle Trader. You may have heard me talking about Inner Circle Trader. He does have a mentorship starting, I think, this Saturday my time, which is Friday his time, Eastern Seaboard US. And he's an absolute legend. So I learned many concepts from him, many of which are shared in this educational series. You'll see me referencing them. I'm not here to make money off of his concepts. Publicly acknowledge that they're his that I learned from, excluding volume profile. He doesn't actually teach that kind of thing. But you kind of take what you can from as many sources as you can, and you make it your own. So here I am. The goal of this course, if you are just jumping on this module now, module 4, you'll realize that what I'm doing is aiming to try and build people up with the structure that they need from an initial understanding, and giving them the meat on the bones of the framework we build as the skeleton to give you what you need to trade a range. Now, in saying this, we don't actually just use this for trading a range. These skills and the skill set that you're going to learn through this course are interchangeable. You can use them in any sort of concept. Trading a range, you can do it in a trend continuation. You can do it in general setup, trading fibs, whatever you want to do. So it's more to just give you some tools and a bit of a toolkit to understand and rely on yourself. And I've had so many messages of gratitude and thanks, and I'm completely blown away by it. So yeah, I'm just happy to be able to help out and share what I can as a passion, and watch other people grow from it. So look, as a recap, we've got a few modules. We've got module 1, which was market structure and Fibonacci. Module 2 was order blocks, breakers, and Fibonacci dynamics. Module 3 was value area trading and volume profile tools. And this module, number 4, is ranges and liquidity targets, or ranges, liquidity, and targets. The next one is trade management and psychology, and the last one is putting it all together. So with that being said, let's have a look. The agenda, as we've said, this one is meaty, and I can kind of feel my voice going already from speaking so much. But we've got part one, ranges. What's in a range? The range tool setup, determining a range, time frame, market structure, and combination ranges. Part two, we have supply, demand, and liquidity. Part three are range-based targets. And part four are range-based setups, followed by part five, which is the universal approach, which is a little thing I came up with that I worked out a bit of a ratio that can help with trading a range. And you can truly use this technique from swing trading, position trading, day trading, scalping, whatever you want to do. So there is multiple aspects to this that can be used that you may not have realized in the past. So, and then the last two items we have are the self-learning and conclusion. So let's have a look. Part one, ranges. So what is in a range? Well, a range, in my opinion, is defined by anchoring 2 points on a chart based on a time frame, so daily, weekly, or monthly, market structure, or a combination of both. So the method I use to anchor the range is a Fibonacci tool with values set at 1, 0.5, and 0. When pulled, you're going to see that you will sometimes need to tweak the range a bit, but we'll look at this as we take a look at combo ranges. So what you'll find here is if we dive into setting up a tool, the range tool, you will find that if you are presented or if you go and check in the top left corner of your TradingView chart setup, if you hit this area here, which is the third item down, go across, you'll see the first number there is, or first cab off the rank is fib retracement. This button here, to click on the star, it adds to your favorites. And we'll just go and have a look at the favorites. If we jump across, you can see down here, these are my favorites. I've got the date and price range, a rectangle, trend line, arrow, and someone actually asked me, I'm going to just quickly digress here, but someone asked me the other day, how do I draw a market structure break line? And it's literally a trend arrow, and you see what I did there? I actually drew the arrow, clicked on it, and it's going everywhere. Johnny Jacks showed me this the other day. Click on shift, and it holds it square, which is fantastic. Now, I do have some templates ready. I've got a couple of different versions, and if I click market structure break black, then you'll see that that automatically generates your settings that you've previously saved. And if you want to amend, you can just jump in this area here, click on text, and add whatever you want to. So the world's your oyster, and you can actually do that with many of these items, and yeah, it's really helped me out. So without further ado, let's jump back into our course. And yeah, you can see I've highlighted here in the red circles somewhere that's going to help you just to highlight the options you should select. So in section 2 here, you've got the 0, the 1, and the 0.5 selected. Background is ticked with nothing on there. I just like to have black, I think. Black, I think they are. And then I've got my levels as values, and the labels are on the right and in the middle. I have got here fib levels based on log scale. Your call. I know because I'm normally primarily a low time frame trader, I won't use the log function, but it's up to you completely. You'll find that different fibs work in different levels. Primarily, if you're using the larger range fibs from 0, 0.28, 382, 0.5, etc., but that's how I trade. So completely your call. It's all about preferences. This is how the range tool should look. So once you set up your fibs per the above, they should look something like this. And I just called it a range tool, which I shouldn't, because there actually is a range tool on TradingView. Nearly call it Telegram, and you can see it here, which is a parallel channel. So if you were to click a parallel channel, do the old shift function like we just did then, and you pull down, then you've actually got a range. And that midpoint there is the midpoint. But I just personally don't like the approach here. It doesn't really gel for me. I prefer to just grab my fibs, right click, template, classic range as I call it, just because my setup here is called classic. So there's nothing super exciting about it. And there you go. You have got your 1, the 0.5, and the 0 level, as we are looking at on our Nifty course. So the 0, the 1, and the mid-range. Determining a range, so the time frame based ranges. As we touched on, we can, in my opinion, and a lot of these things are my opinion because nothing is absolute, we can try to set up with a range based on a couple of factors. So we've got a time frame structure, a market structure, or a combination of both. So let's take a look at a couple of examples down here. So with a time frame based range, we've got these being the simplest in my opinion, as they are literally pulled from the high to the low of a previous daily, weekly, or monthly candle. You can see here we've done some nifty work on this side. We've got a previous week range high, previous week range low. So we've pulled it from a 0 to a 1, and when you can either put the magnet tool on to really select those levels, or you just click roughly, which is what I normally do, and then I will just refine it a bit, and we can actually take a quick look at that. And yeah, my Surface Pro, got to be careful because the poor thing doesn't have that much RAM. I thought it was quite good a couple of years ago, but it's definitely time to reinvest in a new one. So look, for example, here, let's take a look. We've got the daily here. And if we, or let's go to the weekly actually, because we're on that right now. But look, that's our previous weekly range, right? So that's the 10th of Jan. We click on our handy dandy fib tool and you go top to bottom. You can use the magnet tool here, which is over here. There's old mate there. And you can see it'll bounce right up to it. And that one's actually, yeah, that pings right to it. If we did that, that's cool. Then we jump into say 15-minute time frame, or actually 2-hour time frame on that. Trouble is now we've got to go find our range, and you can see that that's it there. And there you go. So that is our previous weekly range that has now been extrapolated across to our next weekly range. So you can see that we're actually just past an inside candle for this week. We're early in the week. What is it? Yeah, it's Tuesday. So if you jump back to the 1 hour or 2 hour on this one, you can see that based on the previous weekly range we've just pulled, top to bottom, that we've hit the mid-range, we've come up, we've rejected, we've had a market structure breakthrough here. We haven't really had much of a chance to retest this, and then we've come right through, dipped past this level here, gone for some liquidity, and now we're kind of working out, well, are we trading above or below this mid-range? So if I was going to take a trade here, I'd be waiting for a market structure break above this level, or I'd be waiting for probably a run down through this wick to liquidity for a run back up, and then seeing if we go and test this wick down here. But anyway, I am kind of digressing, guys, sorry. So there you go. You can see this method, it actually works on the daily and lower timeframes as well. So you can also see on the left of this price action that you could also form an overall market structure base range too, in the form of pulling a fib from here up to here perhaps. And then you can see as price runs through there, we're kind of bouncing off some support and an order block. And then up the top here, we've got a run on liquidity, and here we are at these current levels. So once you understand and recognize that you can use more than one range setup, excuse me, this will make you much more well-rounded and prepared for price action trading. Time frame base range, so 2 of 3. The chart on the right is the drill down version. So this is the 2-hour version of the chart above. So we just looked at that there from the weekly. We've pulled from top to bottom, as we've said. And what you can do here is, in this case, we've got a range that has been determined by a previous week, as we just looked at. So in order to use this method, we need to extrapolate this range shown out to the next trading week where we would be seeking opportunities. You can see that the blue box represents the previous week's range. So that was the previous range that we pulled. You can see we're a bit light on there. Actually, no, we're not too bad. So the low to the high, or high to low, whichever one you want to do. Now, if we pull a new rectangle out to the right, you can see that in the next slide, we've pulled our range, we've extrapolated it, and price has respected the previous weekly range. Remember, this is the one we had before. So price has bounced down again, and then it's come back up, and we have then broken up the top, and we've taken that liquidity above this area here for another retest, and then we've taken some more liquidity, and I do believe that we did come down since then. I made this a little while ago. You can see date-wise here, December 28th. So this is one of the most simplest methods I use in trading a range, and you'll be surprised at how effective the time frame based range setup can be with regard to framing a trading plan. So you can see we've come down, bounced off the bottom, we've shot through mid-range, we've come up, we've just bounced back off or been rejected at this level, come back up, shot straight through, and then price has done its thing. The next one is the market structure based range, and it's quite simple. We call it MS here. I don't actually refer to it as MS through the rest of the course, I don't think, but it's pretty straightforward. So with a market structure based range, these aren't as simple to set up as a time frame based range because you do need to use your eye and a bit of an understanding, but these are relatively easy enough once you build a logical approach. So I do find that a swing low following a steep move down, which in this case, we use this swing low here. I did have a comment from one of the guys I know outside of this course, obviously, where he said, wouldn't you use the swing low here? And you well and truly can. If you pinged a line from here up to the top, then there you go. You've got a super high time frame range, but primarily being a lower time frame trader, I do like to look at what we can play with in the shorter term. So like I said, I use a swing low after a deep move down up to the nearest swing high. And if you had done it to this level, you would then see that you would get run through. So to me personally, the range high goes here. So it can be daunting at first to understand if the range is working based on what you've drawn on a chart, but let's take a look at how this plays out. So anchored on the low, pulled to the high. So as you can see, the range is mostly respected from these initial levels that we pulled our range to and from. So down here, remember, up to here, and then price comes down. We see that as the price action plays out, you can see that range is low is violated. So liquidity run, obviously no doubt, or I shouldn't say obviously because things aren't absolute, but then running up to the mid-range for a rejection, followed by a further range low deviation for another run on Sellside Liquidity resting down there. We'll cover that soon. So based on the range that we would have established on the 7th of December, 2021, it's still valid as of 18th of December, 2021, based on the charts we're looking at. So you can see price ran up, it's come down, it has shown a sign of strength here in terms of bouncing off this area, and then prices come up probably for an ICT's optimal trade entry / entry fibs entry, comes down, blasts past this area here for a liquidity run, and then we see some action up to the top or mid-range, for a rejection, and then price comes down and then sweeps these lows too. So in the last one here, we've got with the tail out of the current date to the 28th of December, as when I wrote this, we can now observe that price has again respected the range low, tested the mid-range, so tested the range low, hit the mid-range again, and then we've gone through this level up top, and we looked at this just before anyway, and you can see that liquidity has been hit, range high has been hit, and I do recall we went smashing straight down through this area, and we have gone past these lows since. So as evident in the example, market structure based ranges can hold their place for a significant amount of time compared to a time frame based range. So as price is fractal in nature, you'll be able to replicate this setup on any time frame, and you'll also note how respected ranges like this are. Determining a range, combination ranges. So this one's pretty straightforward, guys. It's almost ridiculously obvious in my opinion, but anyway, a combination based range is pretty simple in the fact that it is a time frame based range combined with a market structure based range. So in this example, we explore a weekly time frame down to a 2-hour time frame. We'll talk about that a bit later. And then in the following slides, we'll see how time frame based ranges won't always work, and that we need to be dynamic in our approach to a hybrid time frame market structure based range. Timeframe. Does anyone know who Timeframe is? So yeah, look, we've got a range pulled as we've shown previously in our time frame based range. And in here, we check this one out and we say, look, in this drill down 2-hour version of the previous weekly that we marked up with a range, you can see that although the range was once relevant, it's no longer aligning with the shorter term price action. So we've pulled on our time frame based range from low to high. You can see that price is dancing down beneath. It's kind of working out what it wants to do, looking for a level reclaim. And we just realized that compared to this previous price action, we're probably cutting ourselves short in something that's quite obvious. So the remedy to this situation is a bit of common sense, and is the premise of the whole idea of a combination-based range, which really is just intended to be a simple process. So following on from the above, or the example above, in section 2 of 3, you can see how we've simply adjusted the range low to some market structure that suits the current price action, which was down to this wick here. This isn't just a randomly placed anchor point though. So you've got to make sure that the structure makes sense based on where the price has previously traded at. So don't just go willy-nilly and go, oh, holy shit, let's just chuck it up here if price is already running down here, because you can see it's not respecting. If anything, when price starts to come down here, you pull your range from this low, perhaps up to this high if you're expecting a move upwards, but it's just about just being a bit smarter. We're not robots. It's fluid. Trading is never perfect, so don't get sucked into thinking that everything has to be so rigid, right? There's fluidity in everything. So now you can see that the range low has been established and it makes a bit more sense. So again, we've just talked about it. Price is fractal in nature and will experience new ranges as price trades up or down. If you look within this area here, you can see there's already a range in this zone. So price comes up, beats an area and shoots down. So within this overall range, this is a 2-hour time frame. You can have like 1-minute ranges, 3-minute ranges, 5-minute, whatever. There's so many out there. So I really didn't realize for a little while. I do recall someone saying that they did like trading parallel ranges, and I didn't. I never used to, but now you can literally allocate them to most timeframes and realize that there are some simple market structure dynamics that come into play here that become almost universal across any market as well, in my opinion. Part 2, supply, demand, and liquidity. So supply and demand, this is my interpretation. When we look at it, supply and demand are what makes up the market in its entirety. Without someone selling at a level they feel is acceptable, and without someone buying at a level they feel is acceptable, there simply would be no market. So if there's too much selling pressure or supply to overcome the buyers or demand, price continues to sell off until there is sufficient demand from buyers who are willing to pay a price that they deem to be fair. So at a lower level, cheaper price, think sales in a department store. The same goes for buyers who outweigh sellers. If there is an imbalance to demand to the upside, it means that temporarily, as nothing is permanent in the markets, that price will rise until there is enough pressure in the form of supply to drive price back down. So that means that there aren't enough buyers to outweigh the amount of an item available. So in that, we're talking about hitting on a range. So if we just jump back up to this level here, you can see that as we're running up to a supply level, that they're just not buying anymore here. With this level, you can see that there's a demand zone up here, a supply zone, sorry. So there's too many sellers and they outweigh the buyers. So all they can do is price comes back up, retests, confirms that they're selling at this level, comes back up again for another one with a slight, if you draw diagonal arrows, you can see there's a slight downtrend there, and then price shits the bed and comes through. And then down here, we can see there's a demand zone, which we'll look at in a minute. And that's where there's more willing market participants who want to buy than there are who want to sell. And that's where you find support and demand. So the same goes for buyers. I think we just talked about that one. Yep. So this is the premise of supply and demand, where they both act as possible future resistance and support zones. So this is my own interpretation. It's possible future resistance and support. Conversely, though, support and resistance that have been experienced and are actual, they are levels that play out from previously possible levels of supply and demand. So we know that in this area, if price comes back up, there's going to be some supply here that could outweigh demand, which then once it occurs, we can see price rejecting at these levels, then we know there's resistance there. Before that, when you think about it, we're only really assuming, right? Because when price comes down to this level, we can say, hey, look, we think that might be run, and then price runs back up. Without looking at a heat map or a trading light or something like that, then we don't know where these purchase orders are, if you will. So really, when it comes down to it, you've just got to be understanding that these things are, one is future and the other one is actual. So we can only project support and resistance out in future as they haven't occurred yet. Future support and resistance, like the overall markets, are assumptions until proven true. In viewing the below chart, we can see that there are some key supply and demand zones that range high and range low, with much lower levels of supply and demand levels intra-range. So here we can see that as you absorb this, before I just run willy-nilly into it, you can see that as we start down here where price comes through, you can see that people perhaps have shorted this area here thinking, holy shit, we've got to run down. If they've shorted there and then prices come down here, it's found some demand at this level. And then as it shoots back up, any participants who had short stops resting up here have just been taken out. And then price comes back up, and we see that price can't get back up into this area as the bearish order block is tested through this zone as well, where we wick up into it. Then price comes down to this level where there is enough demand in the form of people purchasing and getting long. So you can see that there's demand at these levels to push the price away from the demand zone. So remember the front running analogy, from module 2, spelling mistake, with order blocks. So you can see that price then runs up and then hits the supply zone / resistance again, and it retests this area of supply. And if there's enough supply versus demand, this area becomes resistance. So price then gets pushed right back down again, hits a demand zone where people are willing to purchase and buy. Price comes back up, and then there's a new zone here, which we're just hitting that bearish order block. Price comes back down, retests, runs this low, which although 4 hours, there could be a bit of argy-bargy going on down here with liquidity runs. Not huge though. But then price comes back up, retests again, some bearish action and some supply, comes back down for demand. And then we find out that there's a lot of people that have sold at these levels. So by the time we come back down to this area and people are continually purchasing, price runs back up and through, we tap this high, and then price comes down, and that's quite bullish because we've beaten that market structure break, or that market structure forming a market structure break. Price comes down, and then there literally are not enough sellers to outweigh the people who want to buy, and price shoots up. Price comes up, hits this level here, and comes back down again, where we find and we retest up in this area here. There actually is another supply zone. Hits supply and then comes down for another purchase where people are still willing to buy these prices, and they're holding, they're fighting, they're fighting the bears off. And then price comes up, retests again, and comes down and absolutely poops the bed. So supply overcomes demand and price falls through the range to a level where demand is at an acceptable level again to buyers. So you can see down here, we had that previous wick, and as you can see, price comes down and runs that level there. So we can see beneath this level here that there is price, participants who are willing to buy at these levels. And that's what happens when you see a big sell-off. Go and backtest it on a higher time frame. You'll see that underneath here, these levels always get retested. So you can aim for like a swing high or a swing failure pattern above these levels, which is really a retest of resistance slash swing failure patterns, if you call it, or a liquidity run where people are willing to go or wanting to go and fill their orders to then short the market. So one thing here, note how supply and demand continue to play out. It's an ebb and flow of if sellers are in control, so if they're bearish, or if buyers are in control, so bullish. This replicates from the 1 minute chart to the monthly, and we talked about that here. So many buyers, they come up, keep buying, hit the bears up in the supply zone, overcome the supply, come back up into the next zone, and that's literally what the markets do. So liquidity, we talk about liquidity so much. So price will always seek and be drawn to liquidity. The liquidity price that price seeks is what we're targeting with our trades as exit points with these smart money concepts. So it's a simple concept. Supply and demand levels are where potential liquidity lies in the form of limit orders, only unlocked when market orders are executed. So there has to be a market buy or sell to fill a limit order. So if there's a stop loss that's resting up at $47,000, for example, and price trades up to that, that's when someone's stop loss, for example, if they're short and their stop loss is being hit, it gets triggered. If you've ever placed a short or a long and you do a triggered order, then you'll see that when price hits certain level, then your order executes at a market buy or sell. So when you go and place an order, let's say you're long and then your stop gets hit, and you'll see sometimes you lose more than you actually wanted to. So if you're risking $100, maybe sometimes your loss is 120. It's because when your certain level gets triggered, then it will just market sell. So when bigger players get liquidated, because that's again a market sell, you'll see that if you're a part of that, then you might lose a bit more money than intended because it's purely market unlocking, market sell is being unlocked. So we talk about it a bit more. So when a stop loss level is hit, the triggered order becomes a market sell order, which unlocks the liquidity needed for a buyer to buy from a seller or a seller to sell to a buyer. So in order to move the markets, larger players, so whales, institutions, whoever's got deeper pockets than you or I, they need to drive price up or down to unlock this liquidity at these levels. So it's so they can sell their longs or buy their shorts back. So if you've got a trade exit planned and you've just jumped in, let's go look at this on the chart. Let's say you enter a long here. Where's my favorite tools? There they are. And you go, right, that's my entry. And I'm going to be so smart about it. I'm going to put my stop loss here. And we're aiming for all the way up here. Or let's say here, for example, because then the trade gets hit. We'll move this guy across and you can see the trade gets hit. When you sell up there, because you're long here and you're selling, someone has to be buying that. So in order for you to sell your long, someone has to be buying at this level, which is people potentially who are going short. So they're buying contracts or securities or whatever to then short sell. And then because they're selling up here, they're buying back down here. And that's where you're buying as well if you're going long, for example. But you can see this level here. I'd be surprised if we don't see some sort of extra run. We talk about equal lows, just divergently, sorry. And yeah, I think price might shoot through there and come back up perhaps. But anyway, so yeah, that's the premise of it. So yeah, we talk about this where we say, yeah, so conversely to the above, these larger players also build positions by doing this. So they drive price down or up to areas where they can unlock enough liquidity to then fill their long or short orders. So when we look at that, if price comes down here and is driven for a swing failure pattern, as they call it, where price is engineered because someone doesn't want to release their big footprint of how much they're willing to buy to move the market, and they sell to then go long, they're selling all of these contracts down here to then buy up at these levels, to then move up and above these highs, because guess what's resting up here? Someone's gone short here, short here, short here, or short here. What do you reckon they're doing? They're going to go, rightio, there's my short posi. And by the time price comes up, it runs it, right? You can see these wicked wick areas, so price move quickly up and then back down. So we can see that. Let's say that your orders are getting hit here from a buy side liquidity run, which we'll talk about. And say your price gets hit here, it market sells, and then just goes right where dumping and dumps upwards because it's trying to get rid of as much as it can, as quickly as it can. So that's when you can see some of these wicks where prices quickly go, and that's how you can sometimes tell that stops are being run, or stops are being run up or down. When we use the term liquidity hunt, sweeps of lows or highs, or swing failure pattern, this is what we're referring to. Price will continue to seek these pockets of liquidity to the upside or downside, and will replicate fractally from the 1 minute chart where the scalpers reside, to the 15-minute or hourly where day traders are, to the 4 hour to 6 hour where swing traders live, right up to the 1 day chart for position traders. So the replicating nature of this cycle of liquidity toing and froing is what also defines the market, and is where we can step in as traders and use this to our advantage as well. Now we've got here a liquidity example. So it's similar to the previous slide we shared where we looked at demand. You can see here that if we start in this area, so the short sellers and buyers in this region who have their stop losses targeted are unlocking liquidity for larger players to build an opposing trade idea to the upside. So let's say you see that wick, you go, rightio, we're on, boys. You enter a long here, and then you put your stop loss where? You're going to put it down there, or is that too risky for you? You don't have enough reward, sorry. So you're going to put your stop loss close to here, aren't you? That's when you see price runs up. So participants who were short here, we'll come back to that one. Participants who were short here and place stop losses, they now find that they're stopped out as the market seeks liquidity that their stop losses have to offer. So they've gone, rightio, I'm short at the range high here, and price comes down, hits the mid-range, it comes back up and fills bids, because look what happens straight away up here. Price doesn't keep going up. It's not up only. Price comes back down, finds an area at the mid-range, comes back up, retests these areas, and look what's above this, and all of these, and all of this area here are stop losses. So price comes up, hits them, comes back down, runs through these stop losses where everyone thought they were going to be running up because it's up only season, comes straight back down through, hits these stop losses, runs back up and down, up, down, comes back through, and then look what happens up here. The people who are short up here and up here, if you draw a line straight out, you can see just slightly price wicking into that area, and then look what happens next. Price comes straight back down because they're looking for the next place of where the liquidity lies, which is down underneath this area. So you can see here that's the terminology. As we subsequently test more supply zones, participants who are entering shorts are keeping their stop losses above old swing highs. So as you can see, price eventually runs back up to unlock this liquidity. So it comes back up. If you're short here and you aren't taking profits down here because you're a greedy son of a gun, guess what happens? You come up and get stopped out, and then you learn. So you've paid to learn a lesson. Here's a little blurb. As short sellers' stop losses are hit, which then unlock liquidity as their stop losses turn to market orders, this is known as buy-side liquidity, because remember, if you're up here and you're shorting, you're buying shorts. Sorry, you're selling a security or a token or whatever, and then down here you're buying it back up. So if you have to then, if you're going to get stopped out up the top here, you have to buy your contracts back when you get hit with your stop loss. Same as down here, it's sell-side liquidity. So as long buyers' stop losses are hit, which then unlock liquidity as their stop losses turn to market orders, this is known as sell-side liquidity. This is because they're selling. So they've bought here, or they've bought here or whatever, thinking it's going up, and they've put a stop loss through here. Now what they're doing there is when they have to get rid of these as a stop loss as it's being hit, they have to buy them back, right? So, sell them back. So you're selling at a loss and you're buying at a loss. So it's just all about flipping it in your own head. So that's really the premise in my own terms and words about liquidity. Over here, we've got sell-side liquidity. So we just briefly touched on this. So sell-side liquidity can be defined as the pools of stop-loss orders that are being left in place by market participants who are looking to get long. Now, we can't always assume this is the case because people might genuinely just want to be buying down there. But when we look for these hunts, this is what I assume is happening. So, you kind of build the demon in your own mind, the person you're against, it's the institutions, it's this, it's that. But reality is that most of these spots are probably just where a lot of people have got combined amounts of orders where they're all looking at the chart thinking the same thing. So look, when they enter a trade, or they should place a stop loss on the exchange that they're trading on, this resides in the form of an order that triggers a market sell when a determined price is hit, automated by the exchanges. When price hits this level, orders are market executed and the dynamics of the market continue. So look at this. In the case of a long, they enter and put their stop loss beneath the closes of a swing low, now aiming for the range high. Price rallies up, boom, off she goes, comes back down for a retest, comes back up, doesn't hit the range high, right? So then it doesn't hit it, and when it comes back to stop them out. So price comes back down. If they've entered here, put the stop beneath this one, guess what just happened to them? They've just got blown out the water. Because there's no real other target to put your stop loss under as protection. It's kind of random through here because there's no sort of meat on the bone. But that's what happens. So when we talk about this, this is what's meant when referencing lows or highs swept. So when the market is being pushed up to areas of supply and or demand to unlock the liquidity for moves in the opposite direction. Because how can you buy enough contracts in this area here if there's no one else that wants to sell them to you and you're interested in purchasing at this level? You have to drive price down, to be able to fill your orders, right? And then same as up the top here, like you have to push price up to be able to unlock those orders because there's only a certain amount of orders within this area that you can actually purchase because the rest of the liquidity lies up here where people are willing to sell or buy down here. So then look what happens. Price comes up, hits this area, shoots back down. We bounce off the area where people are happy to keep buying until there's just no more buyers and the sellers win and people keep selling. And that's it. So supply overcomes demand and price breaks through the range low. And now that it's run now price has run the wick into liquidity, it sweeps the lows of this move down here. So that was the big move that everyone shut the bet on, comes back through, and then you can see that we've just peaked and pinged through that area. So interesting area right now. Buy-side liquidity. So buy-side liquidity can be defined as the pools of stop-loss orders, which is just the opposite of the sell side. Beg your pardon. Which is just defined by market participants who are looking to get short. So we just covered sell side. Now we're looking at buy side. So when they trade, they should place a stop loss. And I say should because if you're not trading with a stop loss, unless you're super, super seasoned, you're asking for a kick up the arse. So this is where you should place a stop loss on an exchange you're trading on in the form of an order that triggers a market sell when a determined price is hit, which is automated by the exchanges. Same for liquidations. If you have no stop loss and you're getting your ass liquidated, guess what's happening? The exchange's engine is actually selling all your shit and they're rubbing their hands together because you just got liquidated. So always have a stop loss. When price hits this level, orders are market executed and the dynamics of the market continue. So let's have a look up here. So if a short entry was made here, stop losses could now be placed below, near or high an old swing high. So let's say you were like, holy shit, look at this guys, I'm getting in on this one. You've done your fibs, you've set them up and you've gone sweet, range high, confluence, you've chucked the volume profile tool on and all of your goodies are telling you it's a goer. You enter, where are you going to put your stop loss? There, that's quite risky. It's achievable if you're aiming for range low, but some people might go up here. So same with these people here, they might have gone, look, we're on here. The riskier ones who are more risk prone, they're going to put their stops up here. Same down here as we come to this area, stops up here. So it comes down and let's assume that the participants didn't sell. So they're being greedy or they've got lower targets. Price comes back up and it just bollocks them, like it just comes through here and stops all these people out who had stop losses in this area. That's how price is being filled. So this is what's referenced when lows or highs are being swept, as we've just talked about, is that price is being pushed up into this area in order for people to be able to fill their orders so they can move price elsewhere. And it might not just be one or two people. It might be not a consortium per se, but just enough of the market that wants to interact and push price down to these levels because they have those targets. So it's a phenomenon or a phenomena that occurs and it is what it is. We just capitalize on these moves. Note, so with buy and sell side liquidity, these make great targets to potentially aim for when trading a range as they offer somewhat probable exits for us. Part 3. So guys, we are 40 minutes in pretty much, and normally we wrap our normal modules up, but we've got a couple more parts to go, and it's certainly not a short run. So if you need to, go and have a break, pause it. If you're sick of my voice already, I'm just going to have a drink of water, and we'll keep cracking on. All right. Possible targets. So with trading in general, there is no point in slapping the long or short tool on and then aiming for wherever you think that the tool shows a 2R or 3R. So Crypto Cred, he talked about this in his videos. I did a couple of threads on it. And yeah, the reality and matter of fact is that you're just asking for it if you don't have some sort of structure in place. So you may get away with it for a little while, but look, it's not a threat from me by any means, but yeah, look, it just makes more sense to have a more logical and structured approach to this. And as you can see from the course so far, there is no point in doing something unless we take the time and effort to really work things out. It's the same for trading, right? So we can identify some areas where we think that price will be attracted to, and hence make great targets when partially or wholly closing a trade. And there are 3 types of targets that we cover in this portion of the module. This is not an exhaustive list, and you guys no doubt have some of your own, but these are the ones we'll cover because I certainly use these in my trades. So we have market structure based in the form of swing highs or lows equal bottoms or tops, fair value gaps, and we have the volume profile tool based targets in the form of naked points of control, or even points of control, I should say. So market structure based. Generally, so when we describe market structure based targets, sorry for the formatting, I'm kicking my own butt here. We're talking about swing highs, swing lows, or equal highs or lows, which is shown here. Now, this might seem, and you've seen the PDF perhaps already, because I release these on a Monday PDF-wise, and then videos on a Wednesday. You can see that price trades away from areas that where participants have most likely placed stop losses below or above these points. And as price is driven to and from liquidity pools, this is why we'll see the lows or highs taken out. And you can kind of see it here with price running in the opposite direction, where sells or buys are then filled at the next liquidity pool with enough demand or supply to sustain or repel these moves. So you can see here, had you come down here, we've got a wick, price comes back up, hits the area where there's enough of a supply zone, highs are swept, it comes back down. If you've got long here, look at that, that's your lows being swept, right? They get pinged. So many stop losses would be placed in this area after buying the dip, going long where we've now noted lows swept. So let's say they've done that, price comes back up, bounces up, and you can see that price runs up to these levels and takes these highs out. So when people are looking at targets, and this is what we're talking about in this particular section, is that you can aim for range high and that's fine. But what you'll normally notice is that if you've got the range set up properly, that price deviates below it. And these deviations are where people are selling, liquidations are occurring, stop losses are being hit, whatever. But as you come down through this level, you can see that price sweeps these highs, comes down, doesn't really do much here. There's enough buying pressure because there's some lows and sell side liquidity that's been unlocked through this area here. Price comes back up and then goes, guess where? Straight above this guy. So you can see that price comes above the equal highs of these two, which means that there is liquidity resting up here. And price just deviates above it, fills enough orders, because remember, in this whole box here, if you will, there's only a certain amount of people that want to buy and sell in this area. There are people who want to sell up here and buy down here. So people have to push price up, or not people, but institutions, entities, whatever, or the whole market. They want to push price up to the area where there's going to be liquidity that gets unlocked so orders can be filled. So people push it up, orders get filled, and then it runs, look what happens, straight down. Remember old mate over here? He gets his ass run. So then it gets pinged, stop losses hit, liquidity taken, price runs up again, and guess where it goes? Boom, off she goes, takes out all those stops, all the liquidity there, and it's got nothing else down here. There's too many buyers down in these levels, so price runs up through that way. And that's what we mean by market structure based. So you've got a swing high here or a swing low here. So if you're shorting here and you're aiming for a swing low, great. You're going to exit at range low or just beyond, and you're going to get your boots filled. So that's fantastic. So that's what we mean by market structure based targets. That was bullish or general, sorry. Bearish, we have the same sort of thing where you determine a range. So remember we talked about the swing after a wick. Up to the top, we've got supply. Price runs through, picks this area because people are shorting here. Clearly, they must be shorting for the market to be selling, and they're putting stop losses right above here. Price pings that stop loss area, comes back down, retests the high, and just wicks through this area here, and then price meets enough of its orders that it's looking for, and then shoots straight down through and blows through a range low. Fair value gaps. Had a lot of queries on these ones. They're actually really simple. So a fair value gap, it's a pretty straightforward concept in the fact that price will not only always seek liquidity, but also seeks to balance itself out as well, which in fairness probably is the same sort of term. But this balance is brought about after price quickly moves away from an area where price then seeks to fill these gaps. So these previously sudden moves are then either quickly in their own right or gradually filled in. So the reason for the gap to be filled is simple. If a move cannot sustain the demand to keep moving, supply will overcome it back to a level that is appealing to market participants. So you can see here, we've had price, it's come up, it's hit this area. There's certainly some interest in here. Price runs up quickly. So an FVG, fair value gap, is where an engulfing candle or series of engulfing candles with no opposing move or bearish candles in this case against them, you'll see that prices move quickly through this area where supply overcomes demand and the gap is then filled. So that's the top of the gap, because up here before this all happened, there's a bearish candle. So the gap would have been from that bearish candle down to the top of this bearish candle, which is still current. So if you went to a higher time frame from 4 hours, you would see that that's probably one big ass white candle that runs all the way up, and you can truly see an FVG. But in this 2 hour time frame, it's separated. So price runs through, dips into the area where there's some interest at this support level. Price runs back up, takes this liquidity, and runs through and fills the gap. So price has moved away so quickly. If you looked at a time price opportunity, you'd see this is a poor high, or perhaps not. Actually, in all fairness, it probably would. And then, price comes down and then shoots straight back through this area to fill the gap, because there's not enough buyers or momentum or volume perhaps to push with this move up. I don't really trade with volume indicators, to be fair, but there's not enough buyers to sustain this move. So there's only enough sellers who outweigh the buyers that the price then pushes its way back down. So the FVG, it's filled when price has sought to rebalance itself. And by rebalance, like we just said, price moves up quickly, price moves down and fills it, because this is the median through here. Price doesn't want to trade up there. There's not enough participants willing. So yeah, that's the red rectangle to denote where the sell-off filled the gap, so to speak. Now we've got the number 2 here. So the fair value gaps, they work both ways, so both bullish and bearish. We talked about where price fills these voids. So you can see here there's a last bullish candle, and then in this area here we've got a series of engulfing black candles, in this case, which are bearish or red if you've got a normal setup. So the top of the gap is up here, the bottom of the gap is at the next white candle. And as these FVGs get filled, you'll see that these engulfing candles generally get filled as a balance. So that was on Bitcoin Tether, 2 hours Binance. Let's just go and check that chart and see where we're at here. So did I have that on here, which was module 4? I may have that. I don't know if I do. I've probably taken on a goose chase here, guys. My apologies. So there you go. All right, you can just go and check that as well. I'm pretty sure that did get filled, but have a look. Volume profile targets. How suitable is it that we looked at module 3 in the previous module, which was volume profile, and now we're exploring it again. So this is great. Coincidental. So you can see here we've already explored the volume profile as we've just talked about, and you understand how to set these up, and you also understand on a longer time frame range using the FRVP. It should be FRVP. Atrocious spelling. So what we want to do now is understand how to use a couple of items from the volume profile tools as targets. So we've got the value area high and low. So these are the areas, as we talked about, where 70% of the volume was transacted in a given or fixed session. And you'll see that in the next slide. Then we have a point of control, as we explored in module 3. So it's an area where the most volume was traded against a given price. And these areas certainly hold a lot of interest in the form of historical support or resistance, or future supply and demand, as we talked about. So naked points of control, this is where the most volume occurred in a given or fixed range. And it's where price moved away quickly from this area that hasn't returned to touch this level again. So it's essentially a point of control that never had price trade back up through it to close that off as an area that was traded back through. So that's why we call them naked, because they're still yet to be touched. So here we talk about the value area high and low in terms of the value area high and low, sorry. So we have a naked fixed range volume profile. So if you look here, note how the value area high and low can potentially offer us some structure within a range. Granted, this is a defined range and it's quite lengthy. We've pulled the FRVP from this area down to this area, I do believe, and you can see that based on that we can call these areas here some sort of a range high and a range low based on it gives us some confluence with the FRVP. So don't use this wholly and solely, because you do need to look for your confluence. But if you were to pull this with price, you can see that there is some form of respect given here, but only because it's a larger long-term area. And then when we look at this area here with the naked chart, you can see here that, price, once we draw it in this area, it does spit out a nice representation. Points of control. So a point of control, it's mentioned, as mentioned previously, a point of control is where we can encounter resistance or support depending on the trend or criteria of a potential setup. We can see in this example of how a market structure break-based range is set up and established, where we then have the option of pulling an FRVP tool setup to assess for the volume profile-based resistance. We can see that there is a point of control that is respected as resistance once the FRVP is established manually. So price moves away from this area and then retests the range low. So you can see here, the anchor point is set up from the low here. So swing low for the anchor range up to the top, which is really, we're just using some structure here. And then you can see that the range is established. It actually does marry up with these candle closes. And then we can use the top of this wick. Then look, price comes down and let's say we pull our FRVP from here back to this area. So we're showing it in blue from here to here. You end up seeing that there is a point of control that comes out to this area that can act as resistance. Here's number 2. So when we pull the FRVP to the swing low, now we're pulling it from here down to this area. You can see that there's, after the range deviation, that there is a point of control that sits directly where price was rejected at. So in the previous chart, you can see here the point of control is up to this area because we're talking about where we would potentially enter a trade. And then on the next chart, you can see it's down here. And that offers some form of resistance. So after the range low is tagged and liquidity is taken, as we keep saying, look at that, those lows have been run. We can then potentially see price rally up and then take the next lot of liquidity, which could be resting above the range high. So always assuming that there's a target above range high because there's some wicks into some liquidity and supply up in this area, I should say supply, and then there's equal highs here. So price comes down, doesn't really test it, builds enough of a position down here to run the range low and the liquidity, and then comes up, blasts straight through the mid-range, dances, consolidates under resistance, which is bullish, and then we have the point of control, which is blasted through, that then acts as a support to a certain extent. And then price runs up and then takes out all those resting buy-side liquidity stops. Naked points of control. So here we have got a naked chart, if you will. So pardon the pun, it's not intended, but it's just for clarity's sake. So you can see in this chart that we've anchored fibs at a defined range. Boom, there's one down there and one up there, or up here, down to there. Next, we'll take a look at how the volume profile session volume plays out in terms of naked points of control. So here you can see that in this example, we've established a range based on a swing high before a move down, and then again at the swing low after the retracement. So we've talked about that before in this slide here. Boom, boom, up she goes. We've just done the replay tool and brought it back to this area. You can see that there's a naked point of control which coincides at this area of range high. So let's say you did enter at mid-range, for example. You saw that there was an entry point based on this 1 hour chart. You're happy, you're thinking that mid-range is going to hold as support and you're going to go blast off and take this liquidity. So if you do that, you're targeting the naked point of control, which for confluence's sake also shares a range high based on market structure. Then look, so pardon the influx of color, but as we follow through the points in numerical order on the chart shown to the right, you can see that an NPOC as a target would have been hit at a confluence area of range high. You can then see that these newly established naked points of control form with price drawn up to these areas sequentially. So remember, price always seeks liquidity. And if you'll find that stop losses are being stored above key areas or of range high or naked points of control. So if we look here, let's say you did enter a mid-range, as we talked about in this slide here, you'll see that the naked point of control that we had as a target has then been hit. Guess what happens to price as soon as it unlocks that liquidity? It comes down, finds support in this zone, trades up, and then you can see here a second naked point of control is established because price moves away so quickly from here that we're then left within this session, because remember we're looking at volume profile session volume from 8 a.m. 12 p.m. UTC to 11:59 p.m. UTC. It's 8 a.m. to 8 a.m. my time. Then you can see that price comes up, leaves the naked point of control from that previous session, the previous day, comes back up and actually finds it blasts through the resistance there and taps it. So as price keeps trading, there are several naked points of control that are printed from previous days. You can see here, because price has moved away so quickly, that there is a naked point of control here. So these do make great targets in the form of liquidity or stops resting in areas. You can see here now, that was the one we just looked at. So you can see in this area, we're expecting price to trade back through this one, but we also do have a mega point of control at the top here. And you can see that price doesn't actually hit that big top one, but price comes back down after we just looked in this area here and comes back down, hits that naked point of control, bounces off mid-range, comes back up, beats some market structure, and then goes up, and look what it does. It beats this swing high for liquidity, comes down, and then the bears take control and off she goes. So yeah, you can see that price, once it tags an NPOC, we can see quick reversals. It's due to the fact that market participants find the liquidity needed to fill their orders after tapping said liquidity to move market in another direction or a continuation. Range-based setups. So this is the nice meaty part, and this is now 55 minutes, so thanks very much for your time. So within a range, or to trade a range, we should say, there are 4 setups that I feel work well, and you can remember this is the redacted section that I tease everyone with. So there's a bullish trend reversal, range low. There's a bullish trend continuation, so just after range low, recovering if mid-range holds and price shows strength. Then we have a bearish trend reversal, so a range high. And then we have a bearish trend continuation just after range high, or recovery of a mid-range if price shows weakness. So based on the above, remember in module 1, market structure and fibs, we explored the premise of a market structure break and also a trend reversal. So this really was no mistake. I spent the Christmas break really planning this course out, and I wanted to introduce you step by step. And here we are now. So these concepts explored and covered back then, the intent was to always bring these back into the spotlight once you had a grasp on them. So where we then can study these in some detail now at the appropriate time, which is now. Now I came up with this cheesy ass acronym called RaLEE, which is, I try to make it sound as trade-like as I can, and look, it's cheesy, but let's just use it. So RaLEE, price rallies up, price rallies down, or sells off, I should say. So you're in luck. You've got the cheesiest little acronym going. I spitballed it and I called it RaLEE. So here we go. If I haven't said it enough, it's RaLEE. So we talk about range establishment, liquidity sweeps, entry plan, and exit plan. So RA is from the range, liquidity sweeps with the L. The first E is from entry plan, the second E is from the exit plan. So this has really helped me out many a time when planning trades. So I do love my acronyms, but obviously feel free to make your own. You can use this as a mantra almost when trading this method it keeps me aligned and it keeps me disciplined and true to my approach. If you forget, or you've got a range established and you kind of think like, well, what am I looking for me when I enter a trade? Because me personally, I have a different approach perhaps to you, but it's all good. So look, the reason being is that I've seen many trades fail when I've stepped out of this process. So I do find that the probability of my trades when waiting for a rally setup is greatly increased. So more to process in these slides. Bullish trend reversals. 1 of 11. So bear with me, guys. So in this example, we see that we can establish a range based on the wicked swing low. So down here, which is the range. So that's the RA. And I try to make this, if you bear with me, like each one lights up as we go, you'll kind of get the gist. So anchor, wick pinged, then you've got your swing high here. And we did say that we could use this area, but by the time you start to get to this area here, you can see that that wick will actually probably hold as the range low. So the L, you can see that's light up. So reference RA, which is where we're establishing our range. Then you've got the L, we're looking for liquidity, right? So here we see the liquidity sweep where our liquidity is taken to build positions in what we are assuming or hoping to be the other direction. So price comes down. We've got I'm still highlighting these areas to show where your range was established. Price comes down, hits your liquidity, and then look what it starts to do. Now we have our first E. So if you cast your mind back to module 1, we explore market structure breaks and trend reversals. So remember, nothing is perfect in trading. You can see that if we superimpose the sketch from module 1, the downtrend that reverses with a deep swing, flips support resistance, must be followed by an uptrend with a retest, and off we go. So there you go. We've superimposed that. That's a nifty thing we can do on TradingView. And let's have a look at how this plays out. So you're then looking for a market structure. So I've jumped the gun and looking for playing out, but you've got market structure here. And continuing on with the entry portion, you're looking for a lower time frame because it kind of sucked, to be honest. Looking up here is a bit difficult for an entry, but on the lower time frames, you certainly can see that there is something to jump in on. So we've seen our market structure, it's hit, and I've got my fancy little dunk. There you go, that's been punched. And it's also mid-range. So yeah, there are several setups in this image in terms of market structure break from this area here. But if you're really looking from a high time frame down, you can see that's the most significant area that's been beaten. So it's a market structure break. And yeah, we're going to keep the overall high time frame process for this example, but you can see that this then gears us up for looking for shorts if you're interested and gutsy, but you're looking for a retest and then a run up. So there's our bullish order block. It gets hit, and there you go. If that's too soon for you, you can wait for here. There's another little market structure break, and then enter on a retest, and then off you go. Here's our third entry. So we've got our entry fibs from ICT. So anchored from the last bearish candle before the rally up. Remember that one with our order blocks from module 1 or module 2, sorry. Then you can see that followed by an anchor fib to the top where we broke the market structure, and then we look for an optimal trade entry / entry fibs, and that's where you get a good entry if you're ballsy and gutsy down there. So the price falls back to the entry levels in confluence with the range low as well. And then you can see that in the next slide, we're now looking for exit plans. So because we've met our entry, I've kept a little dunk there for you so you can see that that's our entry point. And let's say you entered the range low and entry levels per the previous slide. What can be some logical and sequential targets? So we've just covered 3 potential types of targets in the previous section. So market structure based, fair value gaps, and volume profile based. So why don't we take a look at them? So from the market structure based exit points, we've got a couple of examples. So we can look at just above the recent swing highs. So there's, again, people who have gone short here. They've nestled some stops that we're looking to expose. And then above the range high, where you could typically expect liquidity to be further resting in the form of a lot of supply. So there you go. There's range high, and there's another intermediate area here that you could aim for as take profit areas. There's nothing wrong with that. Fair value gaps. So this is 3 of 5. So we've jumped to the 2-hour time frame. So we are jumping and chopping and changing. I'm tailoring this to suit because there are examples given based on different time frames within the overall same trading plan. So as you're getting used to it, that's cool. You can do what you need to, but you can play around. You can see there's some evidence here. So based on this, you can see there are 2 fair value gaps that present themselves. Remember, white candle or bearish candle in this respect, down to the next one, which could have been down in this area, but has been filled to a certain extent. And then there's another one through here where there's a white candle there that has traded through. Prices come back up, hit this area, and then that's a form of a fair value gap that's being picked there. So you can see that there are 2 fair value gaps as we've talked about. Volume profile targets. So now we've got our fair value gaps, just keep them in the back burner. You can aim for this one or that one. So then when we looked at the fixed range volume profile, we're now pulling that from this area here where we entered the trade, because you would pull that to that extent when you're looking to get long. And you can see that the FRVP has been pulled from there back to this area where we're entering and have our range established. So we've got a point of control, and then we've also got the value area low, which offers confluence for an entry. So although we're looking for exits here, had you pulled this area, you could see that around this area, we've got some value area low goodness going on. Now, the value area high of the fixed range volume profile also aligns with the fair value gap. So there's a possible layer of confluence there because the FVG, if you remember, happens and occurs in this area. And you can see in this zone here that it actually does as well. So there's a couple of layers of confluence for you. And now you have the volume profile session volume. So we don't have much love in this area here from the intra range section. So you can see up here though, there is a naked point of control, and prices move very quickly away from that. And if you're looking to get long and you really want to target that, then you've got market structure based areas through here to target, followed by this one, the fair value gap here as well, and then an NPOC. So now we've got the trend outcome or the trade outcome, and we've gone through all of these. So we had the RA, the L, the first E, and now we've had the last E. So the trade outcome, had you entered on these fibs and used them as sequential targets as well, which we actually didn't cover here, but we've covered previously, then you can see that your fib levels are hit, your market structure based levels are hit, boom, boom. Then you've got your fair value gaps hit that are shown in blue, and your NPOC's been hit. And price, once it comes up, hits these equal highs, then guess what price is going to do? It's going to go down, look for more areas to fill bids, come back up, and possibly we might see this area run for liquidity runs. So it can be amazing how these targets play out, but of course it does come down to psychology to manage the trade and take sequential profits as we covered in module 1. So don't be fooled, don't get sucked in, take your profits, because no one ever laughed at anyone for doing that. Bullish trend continuations. This is a very simple concept and premise. So these are pretty simple. We can say that, or let's explore the fact that you've got your trade planned out, but life gets in the way. You've got to go to school, work, uni, whatever. When you return to your screen, you find that your trading plan is playing out. It definitely sucks, but that is life. So it's not over. If you feel such a strong conviction when price is trading at or around the mid-range area, so look at that. We've seen our fibs from here to here. It's no different to any of these levels. It's exactly the same example. And you can see that price has come down, played its thing. You're finding some strength at mid-range, and you can see, you kind of go, holy shit, this is actually running up. It's taking some liquidity. You're still confident that it's going to run this range high. So why don't you enter down here where we've got our little dunk going on? So price from A to B down to here, hits the 618 pretty much spot on. And then price runs up, takes out the liquidity above the top, and then goes for that FVG and the NPOC as well. So again, pretty straightforward concept. Is just an extension of the overall move you're running to. It's not a bullish trend continuation in the form of a falling wedge or anything like that. I don't actually trade them. It's a different terminology that I'm using here, so you have to bear with me. That's the only one we're going to cover though, because it's such an easy concept. Bearish trend reversals. So again, we've got a range that gets established with our RaLEE, and you can see that we focus on the bearish case after a possible bullish place. This was just after the initial all-time high, the first one before the second one. And you can see here that we're ignoring this run on lows here, and we're actually going to focus on these areas up here only. So you can see this liquidity sweep. There is one down here, admittedly. Liquidity sweep through this area, price comes down, retests, sweeps through again, and then comes back up. And you can see this. So we're actually looking to get short here based on this whole run down. So E, our entry plan, it's lit up now. So again, we're talking about market structure breaks and trend reversals. So here you have price that runs up, comes back down, has a larger swing high here, comes back down, flips it, and then we're going for a run down, right? So if liquidity has been taken here and there's too many sellers up this way, guess where price has to go? It's got to go down to the next opposing area where there's enough buyers to outweigh the demand to cause or another range or a run in price. So you can see here that continuing on with the entry portion of RaLEE, we have a market structure break down here. So we had this trend reversal that we can see is happening. The market structure break occurs. We can see that, again, there's several setups along the way, but we're just really focusing on one for education's sake. And you can see here that we pull our entry fibs, swing high, swing low, up to this area after the market structure break. And if you enter this area, which is confluent with, or has confluence with range high and the entry fibs, then you're going to be looking pretty good if you had shorted this. I mean, that's a great move. But let's have a look. Now you're looking for your exits again. So what are we looking for? Market structure based, fair value gap, and volume profile based. So when we explore that, we've got some market structure based targets that we can look to exit through here, which is Sellside Liquidity, as we've talked about. And that's where people are putting stop losses beneath these lows. And then you've got some more right down the bottom where people are really probably have put a lot of meat or capital into this move to try and long this, considering it's a 4 hour and it's probably a week's worth of price action there. So again, you can expect even below range low for that one. Fair value gap, we've got one here. It is quite clear and apparent, and you can well and truly see that it gets its ass run down through range low. It's confluent there, so that would have been a great entry down to fill the fair gap, and you're laughing. So then we've got the volume profile targets. So the fixed range volume profile is used in this case from here out to this area where we entered, and you can see that we've got a value area high that aligns with the top of the range, but the value area low kind of, it does make sense, but you probably wouldn't really target that whole end solid. You'd be aiming for range low here. So, and then we check this area here, and this is a really good example, right? Because what we're looking at here is if you don't have a premium version of TradingView, or we're really far back in the past, because this actually was in May last year, 2021, then you can't see this far back with volume profile session volume. So what you've got to do is you can, and it took me a little while, but you just pull an FRVP from 8 o'clock to 8 o'clock my time, or 12 p.m. UTC to 12 p.m. UTC, and you develop all these little FRVPs that become essentially a quasi volume profile session volume, because it's exactly the same thing. You need to probably extend these out a bit more to get a bit more purchase on what they're doing, but there are no naked points of control, and there really isn't enough down here to say, okay, there's some killer targets we're looking for. So it just goes to show that they're a great tool to use, but it doesn't always work. Now, what happened with the trade? So had you explored this market structure break, price ran down, come back up, entered a range high, you've just blown through the sell side liquidity, you've hit the fair value gap, and now you've hit the sell side liquidity objective as well, right down the bottom. Yeah, take profits. Again, don't get sucked into thinking that you're going to be good, because the trade can shit the bed and bite you in the ass many more times than you think it can. Bearish trend continuations. Now, in this example, the gist of it is exactly the same as the bullish trade, but we don't have an example here. So you get your entry here. There is no retest up here. You can retest at range low as a rejection. That's great. But through this area, there is no example of the bearish trend continuation. On a low time frame, perhaps. But in this one, I just wanted to show you that, again, that trading isn't always nice, friendly, or simple. The universal approach. I just need another drink of water, sorry. The universal approach. So you've probably seen this one now, and this is actually something I did come up with. If you're still with me after the above, thank you so much for sticking around. This is an hour and 10 minutes, and it's almost ridiculous. But look, I do have one more little thing and tip to help trade a range, and I call it the universal approach. So the reason for this name is that you can literally take all that we've learned in the above and tailor it to your advantage in whatever time frame you want, from scalping through to swing trading. As we read on, we're going to explore this. So 1 of 6, and sorry, this is where PowerPoint just hasn't formatted from the PDF. So if I'm going to trade a previous daily range as a day trader, pull a range fib from the previous daily high to the previous daily low, as we've explored previously, I find that the best time frame to trade this on is the 15-minute time frame. And let's go and have a look at this. So let's just get rid of all this. Off she goes, boom, boom, boom. On the daily, let's just randomly pull on the previous day. We've got a range high up through this area here, and jump on the 15-minute. Now, I personally find that the 15-minute offers a whole bunch more clarity if you're comparing it to a daily, and you can see that it's easy for me as a day trader, if I was doing that, to have some sort of a sense of understanding of how that looks within a given range. So that's the example there. And in this instance, we do find a couple of trades. Let's say you've got 2 trades a day in here, right? Let's say you come down, you enter at this area thinking, right, I reckon price is going to break range low. We're going to break that as market structure. We come back down, retest, and then you sell off, and you've made a few bucks here. You've made your shekels, right? But you also could have done the same thing and aimed at range low, mid-range, sorry. So perhaps you entered here after this run down and market structure break of this level, and you've exited at mid-range. Great. Then you also have another opportunity here. So let's just, if you bear with me, let's say that you've got 2 trades a day handy based on drawing a daily range of the previous day using the 15-minute time range. So you can see in the chart on the right how when the previous daily range is extended that we can see some nice PA to work with. In trading with this approach, we're going to get perhaps a couple of trades in where this technique works well for day trading. But how do we extend this, and how about we extend it to a lower time frame? Because we like to trade lots and we like to continually enhance our skills. So from a logical perspective, in a singular day range, there are 1,440 minutes. So this is 24 hours a day times 60 minutes in an hour. If we prefer to manage our trades on the 15-minute chart and we feel that there are a couple of opportunities based on this, then we can take the overall minutes of the day and divide by 15. So that gives us, there's your maths there, a ratio of 96. So 15 goes into 440 96 times. So if this gives us a ratio, and go and reread this if you need to, it's not meant to be super sciencey. It's literally just some basic maths. So now we've got the ideal ratio, and we like trading this technique, and we know that price is fractal. Then why don't we take this one step further, and in the same ratio as a day trade, tailor it to scalping or even swing trading? So on the next slide, so scalping. So if you look at a scalp trade using a time frame based fib similar to our previous daily range, let's do some maths. If we want to work from the 3-minute chart as preferred scalping time frame, and we know that our newly determined preferred trade time frame to range pooling ratio exists in the form of a factor of 96, that's just a bullshit wanky way of me saying use the 96 ratio. So 3 times 96 is 288 minutes. So if we divide that into hours, it's 5 hours. So look, I never use the 5-hour chart. I use like the 1, the 2, the 4, the 6, the 12. So look, I would round it down to the 4-hour. Therefore, based on what we've worked out on the previous slide up here, we can see that if we were to use a range-based approach while we pull a fib range from the low of a previous candle to the high of it, then the ideal time frame to establish this range from the rounded down 4-hour chart, so remember we're using the 4 instead of the 5, you can pull a range from the previous candle low to high and then execute scalping trades on the 3-minute time frame based on this approach. So again, we talk about that. Let's say we want to trade on the 3-minute chart. You times by 96, that gives you your minutes, and then you round it down to the closest time frame that you want to trade on. Let's go have a look at that, because that can be extremely confusing as I read it. So 4 hours, same thing as the previous daily range. Let's go here, and we say, right, we want to trade from this candle up here to there. And we jump on the 3-minute, because that's what we've just worked out, that 4 hours divided by 96 is actually, I think, 3.5 minutes, but you can round that down as well. So now if you take a look at this, all of a sudden you've got a range, right? That's being determined by a time frame. And you can see that that's the high of the range, that's the low of the range. Price comes back up, hits this area, runs that market structure break, and then you can actually start to retest this, and then you have a definition of where you could perhaps aim for. Not only do you have some liquidity resting below here, but now you've actually determined a new range on a super low time frame. And now in theory, if we're going to trade on the 4-hour, right, just use this as some basics. That's great for a 3-minute chart, but why don't we drop to a 2-hour chart? Because in theory, again, we can then, what's 3 divided by 2? That's 1.5 minutes, and or 1.5. And what's 4 divided by 2 is 2 hours. So if you're going to reference the previous 2-hourly candle and you really want some scalping, but you want to use some range trading, you can use the 2-hour with the 1-minute time frame. And there you go. You can now see that you've come from a high to a low, price comes up, runs the liquidity, shoots straight back up, takes all of that out, and then now price is recovering, because we can now see that the lows beneath the range have been run, and now we're starting to see some market structure break through this area. So here with market structure, you can see that's been broken. Great. So now people who are in this area, as you pull your fibs up here, and I'll change him up to a classic, you can see that entry falls within ICT's OTE and our entry fibs. If you were going to get in this area and you had it at your range low, stop, nestle beneath there, and you're aiming just for the 0, then you've got a nice 2.17R excluding profit taking. So look, there you go. We just had a quick look at that together. So that's nice. That's actually some live example of that. And that's basically the premise of it. So it looks confusing as fuck when I do it, but if you just work it out and read that, and apologies for the Poindexter shit behind it, but if you just take a look at it, then you'll hopefully understand. And this is where we do this version. And now again, if you ratio it from a 6-hour down to a 5-minute, you'll find that that's a 96 ratio, and you can well and truly go and trade that on the 5-minute chart. So if you like the 5-minute chart and you want to use something like that, then you can absolutely pull the range from the previous as we've been doing. It's kind of hard to see that, sorry. So you got this guy, he comes over here, down to the bottom, jump on the 5-minute, same sort of shit, right? You can see that price comes down, you've got a better version that you're more comfortable with, and as you beat this market structure, same sort of deal again, remember? If you're beating this area here, and price comes up above it, you can probably say around the candle highs, and you start to see a retest, then guess what you can start to aim for? You can start to build all those different targets that we've just talked about with the highs, the market structure highs, the fair value gaps, the volume profile session. Let's take a quick look here. You can see that within that time frame, there is a naked point of control here for now, because, I don't know if that can be a fair definition, to be honest, but you can see that there's certainly an NPOC up here. And there you are. There's a low volume node down here at value area low, and you can see there's an NPOC up here. So if price was to bounce here, lo and behold, you could perhaps aim for there if you were feeling ballsy and you wanted to do so. We'll just blow that guy away and we'll get back into it. So we've talked about that now, and we've also said that we've explained this where I've drawn a previous 4-hour range. Now I've just shown here on this drawing that I've actually, instead of taking that extra 4-hour range out by dragging it, it's just for clarity to show you a separate line of fibs where you can then see, as we just looked at then, funnily enough, you go take a look at that on the 1-minute chart, and you can start to see that how do we pull our fibs on the 2-hour again, and just bear with me, I'm kind of rooting around here. That's Australian for effing around. And you jump on the 1-minute chart, then look how different that kind of feels to to this area here. We've had the lows run, price comes up, market structure breaks, same shit we've always talked about, and then off you go. You can see now, look, price is coming through, and we can just watch this for a second. Goes back up. Is it going to break that market structure? Well, we can come back and check. Yeah, so look, the setups continually present themselves, and you can just, that's how I found it. It was like a little niche thing that I was like, look, I actually really enjoyed trading ranges based on the information with the RaLEE process. So how can I find a good way to do this? And that's what I devised. So maybe you might have seen it somewhere else. Maybe I didn't make it up, but look, it just came to me in that respect, and I worked out a few things, and maybe there's some other smart ass out there using it as well, which is cool. So yeah, that's it. That is it. So there's so much to absorb in this module. It's going to take a couple of readings and listening to my voice, sorry, to get through, but just keep at it. It's going to become apparent soon enough. And if you didn't see through this area and the live versions we just looked at then, where you can literally draw a range on any time frame, then yeah, go back and try again. So look, we'll cover this whole module on YouTube as we've just done. And as a recap, go and practice step by step per order in this module, how to set up a range, concepts of supply, demand, and liquidity, range-based targets, including liquidity, FVGs, fair value gaps, and volume profile targets, and range-based setups, including bullish and bearish reversals, and our friendly universal approach. So use that ratio. You can then actually go back and use that ratio again and think that on the daily, for example, if on the daily, the best time frame to trade on, in my opinion, is the 15-minute. If you draw a daily range, then guess what? Times that by 2 for a 2 daily range. It makes sense that the half an hour, which I don't usually trade on, is the best to trade on, right? Then if you're going to go to a 4 daily, but call it 3 daily, then it makes sense that half an hour times 2 is the 1 hourly. So let's go and have a look at this now. And I just want to show you this because you can see that you're well and truly going to be empowered to be able to do these things. So there's the 3 day. And if we're drawing a range from the previous 3 day from low to high, and we're going to change that to classic range, then, and you were to use the 1 hourly, I think we said, then off you go. So the previous, the 2 daily was the half an hour. So the 4 daily, if you will, is now the 1 hour. And there you go. You've got a high, you've got a low, and you can actually go back and remember we talked about combination fibs, and you can go, right, well, look, do you know what? That actually feels like it probably makes more sense there. And we've got some lows here that kind of feel about equalish. So that's my range low. And then look, there you go. Without even looking at that before, sorry, I was looking over here, and you've got that range low. So we've just looked at pulling our 3 day range, using the 1 hour to manage it. And then look what we just did. We just F'd around and we drew a combination range. So that's pretty cool. That's a couple of the concepts live for you. The next one is conclusion. So wow and holy shit. I never ever thought I'd create a trading course, let alone a module that is 91 pages in length. My wife, she just kind of looks at me and goes like, what are you doing? And it's quite funny. So yeah, she thinks I'm a bit of a psycho, but I do enjoy it. So look, I really want to thank everyone for their support. We've got 13,000 audience members on Twitter now, 2.5, it's actually 2,400 subs on YouTube and 3,700-ish now on Telegram. So I wrote this a couple of days before I did the video. It's such a privilege to be able to share my learnings and approach with you all. So I'm no guru, I'm no god, I'm no master. I'm learning every day as well. So let's keep at it. Let's do it together. If you do find this content of value, please feel free to share it on the socials. I'll throw in that little cheesy old, give it a like and a sub, leave a comment, do whatever you want to do if it's really helped you. So it's all for free. Still to go. We've done market structure and Fibonacci. We've completed order blocks, breakers, and Fibonacci dynamics. We've completed value area trading and tools. And this one is now complete. Let's give it a tick. The ranges, liquidity, and targets. We've still got to go trade management and psychology, and then putting it all together. If you haven't already seen it, I've announced now that I have just partnered up with Bybit, so we're going to do a trading competition at the end of the course as well. So it's going to be really cool. We've got some prize pools to be won, and we can use, it's exclusive for Mindsets followers. Yes, you will use a ref link to sign up to it, and yes, I will make some commission, but I've just talked my ass off for an hour and 24 minutes, so it's probably only fair. Look, there's my Twitter, there's the Telegram, and the YouTube. So thank you guys so much for your time. You know the drill. Say hi to your mum for me. Look after your mates. Buy your dad a beer. Buy your mum a coffee. Take care, and we'll chat soon, guys. Thank you.